Super funds may have to change the way they approach the markets following the global financial crisis. Today I have risk consultant and author Satya Das to talk about whether there will be a need for a super rethink. Das, thanks very much for your time today.
It's my pleasure.
Do you think that this market crisis has given a reality check for superannuation funds?
Not yet, but it will. I think fundamentally at the moment we are in denial. So most super funds have decided this is the deep V recovery, we have a bit of a shock and everything will go back to normal. However, I think over the next 18 months to 2 years what you're going to see is that returns do not go back to normal. We've had a very good first half of the year, but I think that may well prove to be a false dawn. And fundamentally what that will force an assessment of is that the risks overall have changed very, very significantly. And as a result of that, I think you're going to find substantive changes in superannuation in a couple of areas. Number one, the approach in managing the funds. In other words, do people just look for a return or do they actually look for matching of assets with liabilities? And secondly, the return expectations of whether or not they can actually achieve the levels of return that they have in the past, which is a huge issue, particularly for the superannuation industry, for those who run defined benefit, not defined contribution funds. That's become an issue in the United States and in Britain, less so in Australia because we don't have that type of fund anymore in the main.
Has this meant that they have changed the way that they approach risk, particularly in the way they incorporate risk in their portfolios?
I think fundamentally risk and return is obviously positively correlated, but I think there are 2 or 3 things about risk which the global financial crisis reveals. The first is risk has changed. Traditional risk management looks at what I would call exogenous risk. It's things which are like a macroeconomic event, a natural thing happening like a tsunami or something. Also, productivity and innovation. What has happened in the last 25 years is that the nature of risk has completely changed. It's now what we would say is endogenous to the system. So the financial system, the actual actors within it, the banks, the hedge funds, the institutional investors, and the way they interact and the instruments we use effectively create a lot of that risk. And so fundamentally, it's about reconciling both of those. And the other interesting thing about the risk is that we're going to go through a period of huge volatility as the system overall adjusts. After that, we'll have to wait and see where the risk levels settle at. But certainly, assets which are traditionally regarded as being very low risk, like, for instance, highly rated debt, prove to be far more risky in this environment than people would have thought. So I think there's going to be a reassessment of risk generally.
Do you think this crisis has meant that superannuation funds will have to change their whole approach to the way they look at markets?
Well, I think they are thinking about it. I think to some extent super funds are the slaves of asset consultants to some degree. So it's a matter of how they jointly decide what's going to happen. But I think there's going to be 2 or 3 changes. The first is if your returns come down, what you're going to have to do is change the way you manage. What has happened is there's 2 models. The first model is a very simple model, which is what most super funds and pension funds have managed, which is let's maximize the return and hope for the best. The other one is to say, well, this is what I need in retirement or to match my liabilities in the future. I need to have assets. Given the rate of return, what portfolio of assets gives me that? I think we're going to see a significant change to that second model because I think what people will realize is the last 20 years of effectively high returns, which enabled them to run the first model, may not be sustainable. The second thing is, I think, things like leverage will be looked at quite differently. Now, generally speaking, most fund managers aren't leveraged directly. They become indirectly leveraged because they have invested in things like private equity, in hedge funds, and overall financial assets like the stock market has increased its level of leverage in various components. Now, what they've now realized is that leverage works very well on the way up. It doesn't work so well on the way down. So I think there'll be a lot of filtering of leverage. And for instance, I'll give you a very concrete example, which is property trusts. Property trusts 20 years ago had very low leverage and was essentially a way of buying a rental stream, which was very, very stable, and mums and dads loved it, super funds loved it. The problem was over the last 20 years, they've gradually increased their leverage. And so they became quite different beasts. And so under those circumstances, what people now buy will be governed to some extent about their attitudes to leverage, not only in their own circumstances, but how leverage is being used to generate returns.
And do you think that there is actually any opportunities for funds from this crisis?
Well, I think so, because I don't think superannuation is going away necessarily. I think it's going to be there. I think, in fact, there are a couple of things that might happen. One is people might start to realize that super funds and the amount they put into it is actually far too low. So more funds may be required. And I think there will be great opportunities because, like in any great disjunction, there will be investment opportunities which appear. So I think the combination of that will give them some opportunities, but in the short term, it's going to be extremely disruptive, I think.
Thank you very much for your time, Daz.
It's my pleasure.